Hello and welcome to our latest video chat in the Money Show Expert Interview Series. I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I'm speaking with John Bollinger, President and Founder of Bollinger Capital Management. John, thank you so much for taking time out to talk.
Oh, thank you for having me, Mike.
Great. Now, most experienced traders active in this market are going to be familiar with Bollinger Bands, the trading tool you created in the early 1980s. But we do sometimes have some newbies who are watching, trying to learn, get up their trading game and so on. So I was wondering if you could talk a little bit about the Bollinger Band methodology, how it works, and how traders can use those to improve their results.
So Bollinger Bands are pretty straightforward. They're a set of three lines typically. There's a moving average is the anchor or the center of the bands, and then there are lines drawn at an interval above and below that moving average that's determined by standard deviation, the volatility of stock trading. And the point is not so much the technicalities of how they're created. It's what they do, and they define high and low on a relative basis. So with that information, you can then engage in pattern recognition, systems trading, and any number of other analytical activities. So rather than being a system that issues, hard and fast buys and sell, there are an analytical framework that you can use to accomplish basically whatever goals you have that could be accomplished by trading bands. The difference between them and most other trading bands is that they're driven by volatility, so they are adaptive to market conditions.
Okay. What kind of time frames, markets can traders most effectively use Bollinger Bands for? I mean, is it, and I guess I would also ask, how do they work in conjunction with some other technical indicators that people might use in their own trading?
So I primarily use daily and weekly data. That's how I came into the business, and those are the timeframes that I'm most comfortable with. The typical look back for Bollinger Bands is 20 periods. So if we're talking about dailies, that's about 1 month of activity. If we're talking about weeks, it's a little bit more than a quarter's worth of activity. A quarter would be 13 weeks, half a year would be 26 weeks. So it's right in between there. In terms of other indicators that can be used with Bollinger Bands, there are two that are derived directly from Bollinger Bands: %B, which tells us where we are in relation to the Bollinger Bands, and bandwidth, which tells us how wide the Bollinger Bands are. Beyond that, I'm very fond of volume indicators such as David Bastian's intraday intensity as a complementary indicator. Some people also like to use trend indicators like MACD or overbought, oversold oscillators like RSI or MFI. RSI is the relative strength index, and MFI would be the money flow index.
Perfect. Now we talked a little bit about your methodology and how it works. Can you tell me a little bit about what types of signals you're getting today from your work? I mean, what are you seeing in terms of the action in the stock market, and how would you categorize the market conditions out there right now?
Well, right now, by most measures, the market's at least a little bit overbought. We've come on quite a strong run here over the past 10, 15 trading sessions. So it's probably vulnerable to a pullback here. What we're doing right now is what we call a walk up the upper band. That's where the market's strong enough to keep on walking up and touching repeatedly an upper band that's rising. And there are two reasons that upper band is rising. Number one is that the trend component, the moving average underneath it, is rising. And number two, volatility is rising with the rallies. So that's driving the upper band higher. It's a pretty typical configuration, this walk up the upper band. And when we get a little hesitation, when we get a little hesitation like we saw today, the first target that we would expect on the downside would be a test of support at the middle band.
Okay. I had a chance to watch the session that you gave back in February with us. It was one of your virtual expos, and you and your daughter Zoe had talked about how this was a choppy market. You expected that environment to persist in 2023, even though you felt that the October low looked kind of like a classic W bottom. I'm wondering how your thinking has evolved since then. It's been a few more months? I mean, are we still in what I think you called the Ian McAvity type market where you want to buy the dips and sell the blips, or has it changed?
No, it's we're still in that sort of still in that sort of market. I call it a giant trading range market. We've been mired in this market for almost 2 years now. The rallies are good opportunities to take profits. The declines are good opportunities to add new positions to the portfolio. Frankly, this is a portfolio manager's dream. It's relatively easy. You maintain a list of candidates that you want to own, and when the market gives you opportunities to do those, you can step into them. And then you make a list of candidates that you think maybe have gone a little too far, a little too fast. And maybe you want to hedge them by writing some covered calls, or maybe you want to take some profits, trim the positions back into a period of strength. It's a classic swing traders market, and that's the sort of market that I learned technical analysis in back in the 80s. And it's a very comfortable market for me.
Got it. And one of the things that was interesting in that presentation, you also talked a little bit about the VIX, and you suggested that some of the predictive value or information content that we used to get from the volatility gauge has faded. A lot more gaming and arbitraging out of that going on. Why is that? And do you think that that's, I'm kind of curious, the reason I bring it up is that we've seen this ongoing decline in the VIX this year outside of that spike driven by what happened in the banking sector back in March. So I don't know what message, if anything, people should take away from that.
Well, I think it's getting more complicated. Analysis of the VIX, that is. If I was concerned about it 6 months ago, I'm even more concerned about it now. It used to be a primary source of timing and risk information, but all of this zero DTE or 0 day to expiration option trading that's going on, that's lifted option volumes tremendously. Yeah. I think is actually inducing structural changes into the VIX, and frankly, I don't think we have enough data now, enough to understanding right now to see where that's going to go and how that's going to change the parameters that we've used in the past. I remain convinced that the VIX and the whole complex of volatility information is a tremendous source of information for market timers and asset allocators. But I think we need to be very careful in this environment because it is clearly a changing environment.
Got it. Now, briefly, if we shift the chat to some other markets that are out there, treasuries, commodities, I'm wondering what you're seeing in terms of indicators there using band trading methodology.
So I keep an equal weighted index of 19 commodities to get a handle on what's going on there. And that's turned up recently. I was very surprised by that and by the strength of the upturn. So I think that's probably an important component of inflation. And that leads to an environment in which the Fed is liable to be a little bit more aggressive in terms of interest rate increases and other Fed operations. So I think that's probably a negative factor for equities here. I'm not bearish, but could we see a good pullback here if the Fed steps in aggressively and really does some very strong messaging around inflation as they haven't done in the past? I think so, and that could probably produce a good correction for U.S. equities.
Okay. One other thing I wanted to ask you about was managed equity strategies. I know that's something that you were planning on potentially talking about at one of our events, and how they work, how that is relative to traditional alternative investments. Would you be able to speak about that a little bit?
Yeah, so last year gave a perfect example, the so-called 60-40 portfolio, where you're long 60% stocks and long 40% bonds, which is really a hedged portfolio. It's an equity portfolio that's been hedged by bonds, turned in the worst year in a very, very long time last year. And there's nothing wrong with that approach. There's nothing wrong with a 60-40 approach, but it has to be taken in moderation. It has to be done dynamically. It's not a one size fits all sort of portfolio in any way whatsoever. There are times when You want that bond component to be relatively high, it could be 50 or 60%. And there are times when you want that bond component to be relatively low. And when interest rates are very, very low and the Fed is tightening, that's a time when you want that 60-40 portfolio, the bond component of it to look more like 10% or even 0%.
Got it.
And we saw that last year. Our specialty here at Bollinger Capital is, is creating hedged portfolios. And we've done a lot of work in that area. We don't do a 60-40 approach per se, but we have a dynamic hedging mechanism, which we think addresses many of the problems that investors have with risk and the equity environment in general.
Got it. John, I know you're going to be joining us for our Investment Master Symposium in Las Vegas. We're about a couple months out from that now. I was wondering if you could maybe give some of the viewers here a sneak peek at what you think you might be talking about. Obviously, market conditions will change between now and then, but just a little bit of a heads up.
Well, I'm going to be talking about what I just talked about. We're going to be talking about approaches to producing non-correlated streams of returns. So the stock market's been very volatile recently. We think it's going to be very volatile going forward, with big swings both up and down. So we're looking at how to build streams of returns that have low or little correlation to either stocks or bonds. And that's going to be the core of what we're going to talk about.
Excellent. Well, John, thank you so much for your time this afternoon. I really appreciate it. I know our viewers do as well. And if anyone who's watching this wants to hear more from John, learn about some of the strategies he's discussing, I do encourage you to check out the upcoming Investment Masters Symposium. It's going to be at the Paris, Las Vegas from August 8th to August 10th. And you can check out the link in the description below to see if you'd like to attend. So again, John, thank you so much for your time. And thank you everyone for watching.
Oh, thank you so much. And see you at Paris.
Excellent.